Walmart is the first retailer to hit a $1 trillion market cap. They recently hit all-time highs on Tuesday of this week and before pulling back a little tiny bit. Walmart reported earnings this morning. They reported earnings of 74 cents per share adjusted, and that was a beat on the estimates of 73 cents per share. Total revenue grew 5.6% to $190 billion, slightly beat the FactSet views for 190.49 instead of 0.65. Walmart reported e-commerce sales increased 24%, but that slowed quite a bit after 2 consecutive quarters of accelerating growth. Comparable sales for Walmart US grew 4.6%, outpacing the analyst's estimate of 4.4% growth. So things are looking pretty good for Walmart so far. As a matter of fact, Walmart international sales jumped 11.5%, and that's driven by higher transaction counts and unit volumes across all markets. Now, Sam's Club, which is owned by Walmart, climbed 4%, excluding fuel, with Walmart noting strength in grocery and general merchandise items. However, Walmart fell short of analysts' expectations. So Walmart is expecting Q1 earnings to range from 63 to 65 cents per share. That would be about a 3.5 to 4.5% sales growth. FactSet predicted Q1 earnings to be about 68 cents per share. That would be a 5.4% sales growth. So Walmart is sort of pulling back a little bit, and they're saying that they're expecting this current quarter that we're in to not have as fantastic earnings per share growth as expected. Now, Walmart sees 2027 earnings ranging from between $2.75 to $2.85 per share, and that is quite below analyst expectations of $2.97 per share. The company has also announced a $30 billion share buyback plan. And if you don't know what share buybacks are, what that means is that Walmart is going to buy back about $30 billion of their own shares over the course of some period of time. And what that does is it actually makes your shares that more valuable on the market because there are fewer shares to go around. It's basic supply and demand. So the fact that Walmart is buying back $30 billion worth of their company is bullish for two reasons. Number one, they believe that prices will go higher. They're expecting to buy cheap right now. But also that makes the shares that you own that much more valuable. So in this video, we're going to take a closer look at Walmart. We're going to do a deep dive into it and some of its competitors to see if these earnings warrant a buy, a hold, or maybe even a sell for Walmart. Now, the first company that we're going to take a look at is Amazon. Amazon is a behemoth of a company. They have very low debt to equity, but that number is expected to rise in the coming years due to their CapEx spending on artificial intelligence infrastructure. They have a profit margin of a healthy 10.8%, revenue growth about 12%, and EPS growth expected to be 19%. So you're getting Amazon for a very good deal. Their current forward PE is 24.1, and their 5-year forward PE is expected to come in at 12 even. So that's basically getting Amazon right now for a 5-year future of a 12 PE price to earnings ratio. So that's actually quite good. Their PEG ratio, 1.4, could be better. We want that closer to 1 or even below 1, but 1.4 is not too terrible. Next up is Costco. Costco also has very low debt to equity at 0.3. Return on equity is 30% and return on invested capital 29%. Those are some of the best numbers of all these companies that we'll look at today. Not too great profit margins, only sitting at 3%. The revenue growth coming in second place at 7.6%. But this is a company that always trades rich. If you look at their PEG ratio, 4.7. That's more than double what we want it to be at a maximum. Forward PE coming in at about a 47, and their 5-year forward PE at 33. So Costco always trades rich. The problem is if you ever want Costco's valuations to come down, you're going to be waiting for a very long time. Costco is a company that if there's any sort of dip, people buy it up and they never let the price get down. They never let the valuations get down. So just because their forward PE is coming in the 40s and their 5-year forward PE coming in the mid 30s does not mean that this is not a buy. This is just what Costco does. Next up is Dollar General. They are the first company to have free cash flow yield coming in over 7%. EPS growth, second place of these companies, coming in at about 13%. Their forward PE is 21.3, and their 5-year forward PE coming in at 14.3. Their PEG ratio is a little bit high, but this is not really a big growing company. Now, Target is all over the place. They have the second best free cash flow yield at 5.8%. We would like that to be higher at 7%. Their forward PE is the best of all these companies, coming in at a 15. Their 5-year forward PE coming in second place at 13.3, and that's if they can execute on very, very minimal growth of EPS of 1%, revenue growth at 2.4%. But you look at their PEG ratio, and it is just astronomical. Their PEG ratio coming in at 22. So that gives us a little bit of concern when it comes to Target. And finally, the star of the show, Walmart. Really, the only number that stands out here is their return on invested capital coming in at 14.7. They're not a big growing company, so 4.4 for the PEG ratio isn't too surprising, but there are better choices on this list. Their forward PE, very, very rich at 42, and their 5-year forward PE coming in at 27.4. So this is a company that recently has been trading very rich. They hit that $1 trillion market cap valuation, and this is just a company that is it's a dominant player in retail, and people are willing to pay quite the premium for it because they think that Walmart is going to follow through on 10.7% EPS growth. So double-digit EPS growth every year for the next 5 years. That's going to make Walmart trade a little rich. So what we do on this channel is we score these companies on our own unique scoring methodology from -10 to +10. -10 is the worst, +10 is the best, 0 is neutral. So coming in dead last is Costco at a 2. So that is above neutral, but we like scores to be 5 or higher. And we see a very large PEG ratio at 4.7. And we see their forward PE and their 5-year forward PE coming in rich. You might want to give Costco a little bit of a pass there because, like I said, this is a company that's always trading rich. Every single dip is always scooped up. This is just a company that grows and grows and grows despite their very hefty valuations. So Costco coming in at a 2 for growth. Again, you might want to give them a pass. Call it a 3, call it a 4 even if you'd like. Target coming in at 2.5, also because they have a very high PEG ratio and they're not expected to grow their bottom or top lines very much at all. Walmart tied with Target at 2.5. Also a mixed bag here. Really, the only thing that stood out was their return on invested capital. Dollar General coming in for a 3.5 for growth. We do see better numbers across the board here. Their free cash flow yield coming in at 7 really helped their score. And Amazon coming in as the biggest growth company of these 5 retailers, coming in at a 4. Again, we like 5 or higher. And in the past, when we looked at Amazon, we've always given it a pass because Amazon is Amazon. They have by far the lowest PEG ratio. They are ramping up their debt to equity. They are taking on a lot of debt to pay for this AI infrastructure, but they have full faith that this is probably going to be worth it. And so in 3 years, in 5 years, in 10 years, we may look back on Amazon and see that, yes, all their CapEx spending on this AI infrastructure really just made them a behemoth, even more so a behemoth of a company. Their profit margins, 10.8%, 11%, that's phenomenal. Revenue growth, 12, EPS growth, 19. So Amazon is a growth company. It's just we're not seeing the numbers cross certain thresholds that we'd like to see for this company to put them over that 5 mark. Before we get into the safety scores, if you're getting anything out of this video, please consider liking this video. That really helps out the channel. And please consider subscribing to the channel. That way you can keep coming back for more stock analysis and stock scoring and intrinsic valuations. So when it comes to safety, Amazon's probably not going to do too well due to the fact that they do not pay a dividend. Therefore, they've never grown their dividends and they have no consecutive years of dividend growth. So Amazon, we're not expecting their safety score to be too terribly fantastic. Costco coming in with a debt to equity ratio of 0.3%. The return on assets, the best of all these companies, coming in at 9.6. They have grown their dividends 12.1%, which is quite nice, but we don't think of Costco as a big dividend paying company. Yes, they do pay a dividend. Their payout ratio is a very small 27.4%, but you're not buying Costco to get your income supplemented with their dividends. They are expected to grow their dividends for many, many years to come. It's just that's not what they're known for. So we're not expecting Costco to come in too terribly high when it comes to safety. Dollar General, they do pay a dividend of 1.6%. No records of dividend growth at all, so that's going to hurt their scores, but they do have one of the best dividend yields of all these companies. Their PE ratio, also one of the best at 26.1. Target has the best dividend yield at 3.9%. That's really going to help its case in the safety scores. They are dividend kings, paying 55 consecutive years of dividends. They've recently grown their dividend 1.8%, so not a lot. They do probably want to maintain that dividend king status, and so they will grow their dividends very likely, but not a lot. Their payout ratio sitting at 53% lets us know that they probably can maintain and even grow their dividends. They have the best PE ratio of all these companies at 14, and they have the second best 5-year forward PE at 13.3. And Walmart is another dividend king, paying 53 consecutive years of growing dividends. They've recently grown their dividends 13.3% in recent years. Their return on invested capital, 14.7, the best of all, or second best of all these companies. So when it comes to safety scores, no surprise, Costco is at the bottom, 1.4. Amazon, also not too surprising. They come in at the bottom at 2.9. Walmart tied with Amazon, also at a 2.9. Dollar General coming in at a 3.6, almost at that 5 mark, but not quite. But the top of the leaderboard when it comes to safety is Target. Target coming in at a 7.1 because of their large dividends and their 55 consecutive years of dividend growth. So we have these scores. We know what companies are good, what companies are bad, but we want to make sure that we're not only buying the good companies now, but we're buying them at good values. We're buying them at good prices. We want to make sure that we buy at a discount. And so one thing that we're going to do now is compute what's called the intrinsic value. And this is an absolutely essential tool for any investor to compute intrinsic values of companies. We are going to go through PE ratios models, and we're going to go through discounted cash flow models. If a company pays a moderate to decent dividend, we're going to also run a dividend discount model. And what we do is we average those three models together, and we get what is called the intrinsic value, which is not the price. The price is what you're paying, the value is what you're getting. And so we want to make sure that we're buying companies at low prices relative to their intrinsic values. If you'd like to see how to build out these models yourself, go to the description of this video. There you will find 4 links for these 4 different intrinsic value calculators. Like I said, this is an absolutely essential tool for any investor to make sure that they are buying companies at good prices. So coming in last place is Costco. Costco is coming in last place for a few different reasons. Very low growth, very low safety, average score of 1.7. Intrinsically, we think that Costco should be trading for $550 per share. They're currently trading for about $1,000. That is an 82% premium on Costco. Like I said earlier, Costco is a company that if you told me that in a year they're $1,500 per share and we missed a 50% growth, I would not be surprised because it is Costco. When it comes to valuation, when it comes to their growth, not too terribly interesting to us at Interflame Finance. There are probably better opportunities out there, but I do not fault or shame anybody for buying and owning Costco. Now, Walmart coming in second to last with just an average score of 2.7. The current price is $129 per share. We think intrinsically that they should be trading for $80 per share. That means that if you bought Walmart today, you were buying it at a 61% premium. Amazon coming in the middle of the pack at a 3.45. Intrinsic value is $166 per share. They're currently trading for $204. That means that you would be paying a 23% premium for Amazon stock. Dollar General coming in next at a 3.55, intrinsically $180 per share. They're currently trading for $153. So this is the first company that we're seeing with an actual decent margin of safety at 15%. However, because their average score is below 5 and because their margin of safety isn't too fantastic, it's not above 20% like we like to see, this is still something that we're not too terribly interested in buying. It is a buy technically because the price is 153 and that's a 15% discount. However, the score is not 5 or above. So not only do we want decent prices, we want to make sure we're buying quality companies at decent prices. Dollar General does not fit that bill. And finally, Target also does not fit that bill, but it came in so incredibly close at a 4.8. You are getting an 18% margin of safety if you buy Target right now. The current price is 115. We think intrinsically Target should be trading for 140. So Target is a buy. Anything at 119 or lower, it's a heavy buy at $91 per lower. And if we gave them a pass and we called this an average score of 5, then this is possibly something that we might want to nibble at. So if we do round up and we call Target having an average score of 5, then that does trigger these calculators to say that Target is a buy. And if we had a hypothetical $1,000, we would, according to this calculator, put all $1,000 into Target. Now, of course, you probably should not be putting all your eggs into one basket, but of these 5 companies, there's only one that remotely fits the bill at being a buy, and that is Target. We do sometimes give a pass to Costco. We sometimes do give a pass to Amazon, given the fact that they're, Amazon is a big grower. Costco is just a behemoth that everybody buys their dips. But based on these numbers and based on what we do at Interflame Finance, the only company that might be a possible buy is Target. You can even maybe consider Dollar General just because of the fact that they're trading at a 15% discount right now. You're getting a 15% margin of safety. However, it's not the best company, so maybe it's something that you don't want to put all $1,000 into Target, but maybe you want to put half of your money into Target and you want to look for other sectors, other companies to put the other half. This is under the assumption that you want to buy a retailer and you have $1,000 to buy a retailer. So finally, how do these intrinsic values compare to what Wall Street is expecting? Well, we think 550 for Costco. We look at analyst expectations, and you can see that there is an analyst saying that Costco is really worth $230 per share. That is way more bearish than even us. We're saying 550, which does imply quite the large drop in Costco price. But the average analyst expectation says that that Costco is trading for about fair price. They only see about a 1 to 4 to 5% increase in the stock price. The most bullish analyst saying that Costco is probably going to go up 22% in this year. 6 analysts are saying strong buy for Costco, 8 are saying buy, 6 are saying hold, nobody says sell, and there is one strong sell, probably the person that said that Costco is trading for $230 per share. Now, we said that Walmart should be trading for $80 per share, and that is more bearish than even the most bearish analyst in stockanalysis.com. The average analyst does think that Walmart is trading for fair value. It's currently trading for 129, and that's basically what analysts think it is. However, analysts are still saying strong buy for Walmart. 10 are saying strong buy, 19 say buy, 1 says hold, nobody says sell, and nobody saying strong sell. So kind of mixed messages when it comes to Walmart stock. Analysts think that it's trading for fair value right now, that there's not a lot of room for growth. Even the most bullish of analysts says that there's 14% growth, but most are saying strong buy or buy, and that needle is dipping just into the strong buy category because of that. So let us know what you think in the comments below. Is Walmart something that you're interested in? Do you believe analysts saying that this is a strong buy? Do you also believe analysts saying that it's trading for fair value? Or do you agree with Interflame Finance in that Walmart probably has some room to go down before we consider buying it? Now, we think that Amazon should be trading for 166 per share, and that is more bearish than even the most bearish analysts on Wall Street. Analysts saying that Amazon is coming in at a strong buy. They see about a 36 to 44% increase in the stock price of Amazon over the next year. And if that actually happened, to be honest with you, I would not be too terribly surprised. We do own Amazon stock at Interflame Finance, and we will be holding our Amazon stock quite a bit. If it dips below that $200 mark, this is something that we would consider buying. There are 19 analysts that say that Amazon is a strong buy, 23 say buy, 2 say hold, nobody says sell, and nobody says strong sell for Amazon. We feel that Dollar General should be trading for $180 per share, and that is more bullish than even the most bullish analysts on Wall Street. The average analyst thinks that Dollar General will be going down between 11 and 15% in the coming year. The most bullish thinking that it's going to go up 9%. Analysts overall think that Dollar General is just barely a buy. There are 4 strong buys, there are 6 buys, 12 holds, 1 sell, and no strong sell. So the average puts them just barely into the buy category, even though Wall Street analysts do think that Dollar General will be going down in the coming year. And finally, Target trading for 116. We think the intrinsic value is 140, and 140 is among the more bullish analysts and expectations than the Wall Streeters. So Wall Street thinks that Target is just barely a buy, almost a hold. They think that Target price is going to go down between 10 and 13% in the coming year. The most bullish analysts thinking that it's going to go up 30%. And we are on the more bullish side for Target. We think it's 140 per share, and the most bullish analysts thinking that it's 150 per share. So we're somewhere in the middle, but the average analysts think that Target is not a buy. So even though the needle is just barely into the buy, Wall Street does think that on average, Target's going to go down in the coming year. So there you have it, folks. Thanks for joining us. Let us know in the comments below what you think about these 5 companies. Again, if you got anything out of this video, these take quite a bit of time to prepare. Please like, that really helps out the channel. Please consider subscribing so you can keep coming back for more stock analysis and intrinsic values. Tell your friends, tell your family, tell your mother-in-law about the Interflame Finance methodology and scoring method. We appreciate you being here, and we'll see you in the next video.